Hello traders, and welcome back to Explain the Charts. Today is November 2nd, 2025, and we're taking a deep dive into the USDCHF currency pair, which looks coiled for a potentially massive move this month. First, let's break down the news driving the market sentiment. We have a fascinating conflict playing out between the US dollar and the Swiss franc. On one hand, the dollar index has been pushing to multi-month highs, bolstered by a series of hawkish comments from Fed Presidents Schmid, Logan, and Hammack. They're all signaling opposition to rate cuts, which has traders pricing in a more restrictive monetary policy from the Federal Reserve. However, this dollar's strength is being tempered by the ongoing U.S. government shutdown, which, if prolonged, could seriously harm the U.S. economy and force the Fed's hand towards easing. Meanwhile, the Swiss franc is living up to its reputation as a resilient store of value in a fearful global environment. Multiple reports, including one from Bank of America, indicate that quantitative signals are turning increasingly bullish on the franc. This creates a powerful tug-of-war, a fundamentally strong dollar versus a classic safe haven franc. News outlets are highlighting that USDCHF is testing major confluent resistance at the top of a multi-month consolidation pattern. Analysts are specifically pointing to the 0.8040 level as a critical line in the sand. A close above this level could signal a larger trend reversal is underway. Interestingly, Barchart's technical opinion is a 24% sell, with a weakening short-term outlook, which adds another layer of complexity to our analysis. So, let's turn to the charts and see how this narrative is reflected in the price action. Looking at our daily chart, we can see the broader story of 2025 very clearly. After peaking above 0.91 early in the year, the pair entered a steep and prolonged downtrend. This bearish move found a significant bottom in early July, right around the 0.79 level. Since that low, the price action has been a story of recovery and consolidation. The market spent several months building a base, trading mostly sideways between roughly 0.79 and 0.8070. This long period of consolidation is exactly what analysts were referring to when they said the pair was coiled for a breakout. A consolidation phase after a strong trend often precedes a significant move, as buying and selling pressure build up. In the last week of October, we finally saw that pressure release to the upside. The price decisively broke out of this range, surging over 2% from its monthly low. This powerful move suggests that bullish momentum is taking control in the medium term. The former resistance of the consolidation range, particularly around 0.8000, should now theoretically act as a new floor of support. The primary resistance to watch now is the high from this consolidation period, which sits around the 0.8072 to 0.8076 zone. This level represents the September and October swing highs and is the next major hurdle for the bulls to clear. A break above that would strongly indicate that the multi-month downtrend is over and a new uptrend is beginning. Now, let's zoom in on this recent breakout action since September. Here you can clearly see the sideways price action that defined September and most of October. Then, on October 29th, we see this massive bullish candle that ignited the breakout. This was followed by two more strong days, culminating in the October 31st candle. That final candle of the month closed at 0.80444, notably pushing through and closing above that key 0.8040 resistance level we discussed from the news. This is a technically significant event. A close above a major resistance level often confirms the validity of a breakout and signals that further upside is likely. This move aligns perfectly with the hawkish Fed commentary that emerged during the same period, giving us a clear correlation between news and price action. Switching to the 1-hour chart, we can get a better feel for the short-term momentum. The price action since October 29th shows a very clear and steep uptrend. We can see a pattern of higher highs and higher lows, which is the definition of a healthy bullish trend. The price has been respecting ascending trend lines and key moving averages on the shorter time frame. After peaking just above 0.8050 on October 31st, the price has entered a period of consolidation, trading sideways. This is typical price behavior after a strong impulsive move. The market is pausing to digest the gains before deciding on its next direction. For short-term traders, this current tight range around 0.8040 is critical. The previous intraday highs around 0.8000 could now serve as an initial support level if we see a pullback. Now, let's drill down even further to the 15-minute chart for the last day of trading. Here, we can see the microdynamics of the battle for the 0.8040 level. The price made an initial push higher, was rejected, and has since been forming a tight horizontal consolidation. This pattern looks like a bullish flag or pennant, which are typically continuation patterns. This suggests that despite the pause, the underlying pressure is still to the upside. For scalpers and day traders, a definitive break above the high of this range, around 0.8053, could be a trigger for a long entry. Conversely, a break below the range's support, around 0.8037, might signal a deeper pullback towards the 0.8000 support zone. Watching the volume on these small timeframes can also give clues. A breakout on high volume is a much stronger signal than one on low volume. Okay, let's switch back to the daily chart to recap and look ahead. The key price levels to watch are clear. Our major, long-term support remains at the July low around 0.7900. Near-term support is now the zone between 0.7964 and 0.8007. As long as we hold above this, the bullish thesis is intact. The immediate resistance and first target for bulls is the 0.8072 to 0.8076 area. Beyond that, further resistance lies at 0.8120 and then the 0.8172 to 0.8185 zone. So, what's our prediction? Given the decisive breakout and the fundamental support from Fed commentary, the bullish scenario seems more probable. I would place a 65% likelihood on the price continuing its advance to test the 0.8076 resistance in the near future. For this to be confirmed, we need to see the price hold above the 0.8000 support level on any pullbacks. The bearish scenario, which will give a 35% chance, would involve this breakout failing. This would be a fake-out, where the price quickly falls back below 0.8000 and breaks the 0.7964 support. This could be triggered by surprisingly weak U.S. economic data or a sudden flight to safety that benefits the franc more than the dollar. Keep a close eye on upcoming Fed speak and any news related to the U.S. government shutdown, as these will be the primary catalysts for the next move. A conclusive break and close above 0.8076 would be the ultimate bullish confirmation. Finally, please remember that this video is for informational and educational purposes only and should not be considered financial advice. Trading Forex involves significant risk, and you should always conduct your own research and analysis before making any investment decisions. Thanks for watching Explain the Charts, and don't forget to like and subscribe for more in-depth analysis.